We'll get started, shall we? Okay.
Sorry.
Thank you. Well, thank you and welcome to this keynote panel on the topic Navigating Mining, Investment, M&A Opportunities and Geopolitics in the Evolving Gold Market. My name's Cosmo Sturge. I'm the Market Strategy Director at Baker Steel Capital Managers. It's my absolute pleasure to be here to moderate this panel, where we're lucky enough to have some true industry experts here to give an insight into the drivers and opportunities in the gold sector. Before we get started with the discussion, though, I'll ask each panelist to introduce themselves. So if you could each say a few words about yourselves and your companies and backgrounds, that would be really helpful. So let's start with Frank.
Okay, I'm Frank Giustra. I've been in the mining finance business for over 4 decades. We've financed and created mining companies around the world. I took a liking to gold 25 years ago and have written a lot about it, spoken a lot about it, and have very strong opinions about it.
Okay, Ronnie.
Thanks. Ronnie Stöferle from Austria. Our company Incrementum is a boutique asset management company based in Liechtenstein, running roughly 500 million Swiss francs in 5 investment funds. And then I'm also writing, I'm not sure if it's the best, but it's at least the biggest report and the longest report on gold. It's called In Gold We Trust. Doing it for 19 years already. So wrote a couple of thousand pages of research about gold, and next year we've got our 20th anniversary, so we're already working on our next edition.
Very good. And Ruth?
And so I'm Ruth Crowell. I'm Chief Executive for the London Bullion Market Association, or LBMA. So it's our role to advance standards for the common good of the global industry. We're probably best known for London Good Delivery, so defining what is acceptable in the largest physical market in the world, $165 billion a day, and generally there to be a communication point for the world's largest OTC market for gold.
Okay, fantastic. Thank you. From my side, Baker Steel is a specialist fund manager. We're focused on active investment in the mining sector. We manage about $2 billion of predominantly institutional investor money. So the discussion today is particularly pertinent to me because a lot of the key investors with questions our investors ask are, of course, the ones we'll talk about now. So let's kick off. We'll start with the first round of questions about the gold market dynamics and evolutions. So maybe to begin the discussion with Frank, as someone, of course, with deep experience of investing, could you give us an overview of how you see the drivers of the gold market and how they've evolved over time?
Well, I have a very specific thesis that I've been developing over the last 5 years. Some people agree, some people won't, but so far it's proven to be right. And what I think is happening here is that we're seeing a global shift in the monetary system, unlike anything we've seen in the last 80 years. I think we're experiencing a reset of the global financial system with respect to what is money, what is considered to be money. And when I started connecting the dots, there were 4 dots that I started connecting about 5 years ago, and now it's becoming clear that gold is going to play a role in that monetary system. And the 4 dots are this. You had, first of all of these central banks, specifically China, India, and others, but almost every country outside of the G7 accumulating gold with a voracious appetite and an accelerating pace. Those same countries, some of those same countries, created the M-Bridge project, which started about 5 years ago. And M-Bridge, in very basic terms, is a currency, it's a forex settlement system that uses central bank digital currencies between countries to settle forex trade. And it's and one of the biggest criticisms that came out when I first suggested that this was really competition for the US dollar was that people were saying, well, why would anybody want to sit on unwanted yuans, for instance? People are happy to sit on US treasuries, but what would you do with Chinese yuan if you have a trade surplus on a bilateral trade agreement with another country? And I said, well, wouldn't it be interesting that you could possibly settle those surpluses, unwanted currency, with gold? And I thought it made sense because China, in my opinion, has been buying a lot more gold than they've declared. They probably have 5 to 10 times more gold than they've declared officially. And they were doing it for a reason. So you had the M-Bridge, which is it's a system, currency system that sits outside of the US dollar system. So that's number 2. Number 3, the ability for institutions and governments to exchange their yuans on the Shanghai Gold Exchange for physical gold. That was the next step. And that was clear to me there was a purpose for that as well. And the last thing, which just occurred very recently, was the setting up of physical gold vaults. The first is by China, first one in Hong Kong, 2,000 tons, with plans to have them throughout Asia and the Middle East. They're looking at Dubai, they're looking at Singapore, they're looking at Switzerland. And the purpose of these, in my opinion, is to potentially settle currency trades where there's unwanted currency. So take an example. You got Saudi Arabia and China trading with each other. At the end of a period, Saudi Arabia ends up with surplus yuans that it has no use for. You don't want yuans? Fine. Go to the Shanghai Gold Exchange, exchange them for physical gold, take delivery wherever you want. That is the direct challenge to the Western-based dollar system. And if you look at it as simple as this, it's like a digital monetary superhighway paved with gold bricks. And so if you're ever puzzled to what's going on with the monetary system, just follow the yellow brick road. That's what I say, because that's where we're heading.
It's fascinating. Thank you very much. Maybe if we move to Ruth, down at the end there, given the LBMA's central role in the precious metals markets, do you have any insights you could share on these drivers?
Well, I think it's been an incredible year for gold. You know, I think for those of us who've been in the industry and watching the story for a long time, I think the case for gold as a high-quality liquid asset has always been strong. But I think the main changes I see has been the demand, the growth demand around the world. I think Frank's absolutely right. Asia is coming to the fore in a real way. But I think we've also had a complete reset of the geopolitical world order, the financial world order, where central banks in particular are looking for an alternative to US dollar or US debt as well. And there's not an obvious next currency, but actually many of them either have gold that's being produced in nations such as China, or they actually have historic stocks. So we now see a situation where central banks have been buying at record levels, 1,000 tons a year for 3 years, with no sign of that stopping, even though we're at $4,200 or so an ounce. So I think the central bank story has been going on for a long time. I think growth in Asia, absolutely. I often get asked, you know, does this mean the market will move as if it's a zero-sum game? I think it's an expansion. I think people are starting to recognize not just the value of gold as a safe haven asset, but as a strategic part of any portfolio. And I think the key point that a lot of the banks were looking for is they look, you know, what's the longer term case? What are the headwinds out there? You know, the interest from macro investors certainly coming into the fall was clear, but it was also a question of going into 2026. Are they going to start to say, this is a drag on my portfolio, I'd actually like to put it someplace else? That hasn't happened. Really, the macro interest from many of the banks and their clients are saying that this is something going forward. So it's started to take a note out of central banks around the world. So in terms of drivers, I think physical remains crucial. And I think that it is king, and it's going to be something that you saw with some of the disruptions in New York because of tariffs, of could it get across the border, this sort of aspect, which will continue to be focused on as we move into 26.
There's some strong drivers. And turning to Ronnie, you quite literally have written the book on gold. So can we hear a couple of your perspectives on this?
Well, you know, Ruth and Frank already said the most important things, but I think, you know, if we have a look at the gold chart, I mean, you can tell that there's so much momentum and strength behind, because every minor correction has been bought. You know, we saw like in October, gold was down 5.4%. And I thought, okay, this is like the beginning of a bigger correction. But no, there was actually so many people waiting on the sidelines, so many people that missed the gold party that just wanted to enter, that, you know, those corrections tend to be really, really shallow. So, you know, the momentum in this bull market is just, you know, it's astonishing. And it's not only in gold, we are now finally seeing it in silver, and we're seeing it in the mining space. So I think going forward, I've got a couple of drivers that are most important for me. First of all is a dollar bear market. Kevin Hassett is probably going to be the next chair of the Federal Reserve, he's going to be very, very dovish. So we'll see, somebody wrote about the REM trade, return to easy money.
Oh, yes.
That's the new term. So that's going to happen. Then I see a comeback of inflation. So we'll basically have a somewhat stagflationary environment going forward with negative real interest rates again. Then I think that central banks, especially from emerging markets, will continue to buy. Poland just said that they want to go up to 30%. I think that would be an additional 180 tons of gold. And then we're seeing, finally, I think, the financial media and Wall Street is always coming up with buzzwords, and now we've got the debasement trade. It's like the new big thing. From my point of view, we're having that since 1971, and, gold is up a CAGR, compound annual growth rate, since then of 9.4%. I think that's pretty decent. But now everybody is talking about this debasement trade. And I think what it means going forward is that from the by far largest asset class, which is fixed income, that's 170 trillion. I think more and more capital will move into precious metals, into commodities, perhaps also into the equity space. But I can tell you, from talking to fixed income managers, they say, well, perhaps, inflation isn't dead like central bankers keep telling us. I was referring in an article recently to bond funds actually in the 1970s that were allowed to hold up to 40% physical gold. So a bond fund had the mandate to actually hold physical gold. And I think this is really the big story. Money flowing from fixed income into precious metals. I think that's going to be the big trend. And, let's face it, new debt in the first half of last year, 21 trillion. That's basically the market cap of gold now. The US government deficit in just the last fiscal year, there was 2 trillion. That's the GDP of Spain, which is the 12th largest economy. So I don't really see an end of this whole, debt party, and I think that should be, for the long secular bull market, I think one of the most important drivers.
Yeah, absolutely. No, thank you. So that's fantastic. Maybe if we move on to the next round of questions on the physical supply and demand outlook. Of course, as mining equity specialists at Baker Steel, we appreciate the supply side tightness in the gold sector and the challenges faced by miners. So it'd be great to hear your views on this. Maybe if we begin with Frank again, from a mining perspective, what do you have to say about the production opportunities and challenges, particularly in this higher gold price environment?
Well, I think it's a wonderful time to be a gold miner. You've got a perfect storm of lower energy prices and higher gold prices, so the margins are great. I'm invested in a few that are just killing it with cash flow, and I think that's just going to continue. I think, and at some point, it'll be reflected much better than it currently is in the marketplace. Yeah. So I see tremendous. Our organization is in the business of creating mining companies. We've been doing this for many decades, and we see opportunities all the time. But we're not going to see the sort of discoveries that we saw, say, in the early 90s, these real world-class discoveries. We haven't seen one in a very, very long time. So the supply side will be just that steady growth of 1.5% to 2%, which has been forever. It's, no matter what the gold price is, that's 1.5% to 2% inflation growth on supply. So I don't see that changing, because they're just, the deposits are getting far and few between. The good ones are very difficult to find. The grades are lower and lower. Someone showed me a deal the other day with large deposit, but 0.45 grams per ton. And I remember years ago, I used to think 1 gram a ton was ridiculous. I would never touch it. And now today it's the standard. But I'm not ready to go to 0.45 grams per ton yet. But that's what the mining world is facing. There are just no new, very large, world-class, high-grade deposits. Are difficult to find.
So lower grades and a lack of new discovery.
Yep.
Ruth, from an LBMA perspective, how do you see that physical demand outlook?
Well, I think we certainly represent the demand part of this equation. And I think as we were talking about the change in the market, the demand is huge right now. So we were chatting before, LBMA has a big conference every year, and it really is the world's experts coming together. And I think we all wanted to get a better understanding of what an incredible fall this has been. You know, is this a moment or is this a new chapter? And I think the overarching refrain, it's certainly a new chapter because the demand is not just coming from one part of the world, it's coming globally. And that for even players who've been in the market for 10, 20 years, it's the largest amounts of new clients they've ever had. I think the other aspect is interesting. You know, the FT story that came out very recently talking about Tether's move into gold, if you haven't seen this, in terms of the golden whale, I think they're being described as. But it's an opportunity to democratize even further beyond what ETFs have done, but in a more direct way. So it's certainly one to watch in terms of other avenues where demand can be captured for gold.
Yeah, makes a lot of sense. And Ronnie, from your sector research, could you comment on those trends? And I think particularly the point Ruth raises there on cryptocurrencies, I think is one which is worth hearing everyone's thoughts on. But of course, we'd love to hear yours and then Frank's as well on on how that can fit within the gold story.
Well, I talked to one of the Tether guys, Juan Sartori, who actually, I think, bought Sunderland FC. Oh, and we were talking about football, and I said my favorite team in Austria is struggling, and he said, I'm going to buy it. And he said, I would appreciate that. So that was like in Beaver Creek at the Precious Metals Summit, that was like the talk of the town, basically. And I think it's kind of ironic that, you know, they're getting all the coupons from the US treasuries, and then they're investing that money in farmland, physical gold, and I think they're buying like 2 tons every 2 weeks or something like that, and then Bitcoin, and now recently also in the royalty and streaming space. I think that's a pretty interesting development. And now with the Genius Act, I think stablecoins will become even more important because the US is becoming, or has to become, really creative when it comes to finding new buyers of US treasuries, and I think stablecoins are now like the 4th largest buyers of US treasuries. So with the Genius Act, this will become even more of a topic, and they will recycle that money into gold and royalties stocks. That's an interesting development. Now, talking about the physical world, I thought it was interesting. We did some field research I think in October, gold went up $400, something like that. So it was crazy. We remember we woke up every day, new all-time high, and we got kind of used to that. So there were like big lines in front of the gold dealerships, and a colleague of mine, he went to one of those gold dealers and just started talking to the people standing in line. And it was an interesting mix. And some said, I'm selling my gold, I'm taking profits. Some said, I'm buying some, but I'm a little bit shy. You know, I'm buying gold for the very first time. It feels like kind of weird. And some were saying, well, I'm flipping to silver. So I think we're not seeing this. We're in a bull market, but we're not like in a mania stage. Because let's face it, this bull market is primarily being driven by emerging markets. This is where the physical demand, where the growth is coming from. In the Western world, we're still heavily underweight gold. JP Morgan just came out with a study, 2.8% allocation. In the institutional world, we talked to UBS for family offices. They now hold 2% of their total holdings not in physical gold, but in precious metals in general. And you know, that's not a hedge for a family office. That's more of a pocket change. So I think, you know, this is really becoming more mainstream in the Western world, finally. Yeah. And it's all about this, somebody called it the denominator decay. So people really losing confidence in the future purchasing power of money. And that's a real issue that we're having in the Western world. And I don't think, you know, this is going to end with, you know, the political leadership that we're having in most countries. I don't think it's going to end very soon.
And just to agree with you, I think on that, I think the benefit of gold, it's nobody's liability. You know, there's not an issuing central bank. Like you need to be confident of the purity. It should be LBMA grade. Ideally, I would say that. But ultimately, it really de-risks significantly in a world that's becoming more and more uncertain.
Yeah.
It's interesting about Tether. You know, Tether now owns more gold than it does Bitcoin, and which is really interesting. I met with your friend as well, and I think they see the writing on the wall. If Trump gets his way and we get a new Fed chair, you know, that 4% yield is going to go down, and that's basically their business plan, is working off that yield. So they're moving all their money to farmland, gold, and then Bitcoin. On the stable coin stuff, which is very interesting. So obviously, to me, it's obvious that with the Genius Act, they found an ingenious way to create additional demand for U.S. Treasuries at a time when foreign demand is falling off a cliff. You know, you've got China de-dollarizing, many countries de-dollarizing. And so I thought that was a very ingenious move, and it will work if they can create a stable coin system worldwide, you know, for payments, remittances, you know, financial applications of all sorts. But it has to be a real global adoption for it to basically replace the utility of the petrodollar. Because what's happening here is that the torch is being passed from the petrodollar to stable coins. Because the petrodollar is losing its efficacy as well. You know, 20% of the world's oil is now traded in non-dollar terms, and that's just going to increase over time. The Bitcoin stuff, you know, I'm a little bit of I'm finding it difficult to buy the narrative that Bitcoin is like gold, no matter how often they repeat it. And they repeat it over and over. It's like, you know, the Wizard of Oz. If you close your eyes and click your heels 3 times and say it over and over, it'll become true. But gold, it does not trade like gold. No. It never has. It's a risk-on asset. It certainly trades that way. And you've got all these digital age carnival barkers out there making wild predictions, creating feed and greed and FOMO as a means to generate new buyers for Bitcoin. And so I think I think if it's a long way from catching up with gold, and I think the price is telling you how the world is voting. You know, the world is voting with gold, and it's central bank demand that's taken it to these levels. The ETFs are just icing on the cake because they're not really. Since China took over the pricing of gold, which they clearly now have, it's really interesting. You've seen all that manipulation that was taking place with paper gold. It's disappeared. And some of those LBMA banks were playing that game for a long time, and now they can't manipulate it anymore. They can't. And this is why gold has gone straight up without a correction, because now China has pricing power. It's no longer in the hands of the LBMA. And so I think we're in a new era.
That brings us quite well, I think, to the next sort of round of questions, which I have here, which is really about the evolution of those paper markets and the ETFs. And of course, we all know they've been incredibly popular ways for investors to play physical gold. We certainly see clients of ours who hold that alongside our Baker Tilly Precious Metals Fund in the equity side. So maybe if we move to Ruth, you maybe to hear your views there on just how those gold ETFs have impacted the gold trading and how you see those products evolving.
Well, I think in terms of ETFs, we celebrated 20 years of the first ETF. I think it's ultimately been a fundamental change for the gold market. It really brought in additional liquidity. It's been one of the reasons we've seen an end to the central bank gold agreement, is that the market is sufficiently liquid, that you don't need this kind of agreement going forward. And it's really opened up the gold market to a different avenue. Now, I would agree with Frank in terms of crypto generally. I do love this quote that people talk about Bitcoin as gold, but I also really enjoyed that gold is natural Bitcoin. The reverse, I think, is quite amusing. But no, I would say ETFs is one way to access if you're not part of the wholesale physical market. And that's what London is looking after. That's the physical stuff. I think you need to speak to the CME if you're wanting to talk about futures and the paper side of things. So I think ETFs has been an important part of it, but if you look at the volumes, because we have 5 years of data now, and that's been one of LBMA's big achievements in that we didn't agree with Basel coming out saying that gold's not a high quality liquid assets. We had all the qualities, but not the data. We now have the data. If you haven't had a look at that, encourage you to do so. Gone from one of the most opaque markets in the world to one of the most transparent. And that's certainly a lot of my time going around talking to central bankers. If they haven't investigated for themselves, please It's there, it's transparent for everyone to look for themselves, which I think, one, sets the market up in a good place as the world's attention has moved to gold for the reasons we've talked about. If they want to see holdings, if they want to see spot forward options, daily turnover numbers, that's all there for inspection. But in terms of where we go from here, the reason I raised the tether point is, to me, I see it as an access to physical, as a fully backed stable coin. But I completely agree that ultimately, when it comes to these markets, gold, it's a 300-year-old market. It's still quite new on the crypto side of things. And you see that in some of the market behavior and people who've taken part. That being said, I don't think it's going anywhere either.
Yes, absolutely. And Ronnie, do you have any comments there on the paper side of the gold market?
Well, I think, there's ETFs for me, or ETF inflows and outflows are like a proxy for Western financial investors for me. Because we as a fund, for example, in a UCITS fund, you're not allowed to buy physical gold because it's too risky. But we can buy, UK government debt and lever it 10 times, whatever. It's not too risky. So talking about financial repression. But we can buy gold ETFs, for example, yeah. And I think what was interesting, until last year, there was a big gap between, the price of gold and actually inflows into the gold ETFs. So that was a sign for us that actually the majority of Western financial investors completely missed the gold party. So this was really driven by emerging market demand. Now we're seeing some decent inflows, while pretty interesting for the GDX and GDXJ, so the mining ETFs. Actually last year, but also this year, we're seeing outflows. Yeah. Even though we're seeing a pretty spectacular performance, so probably most of the money is going to Baker Steel. No, but I think it tells you where the sentiment in like the mainstream or the generalist market is, and I can tell you that from talking to clients, it's not like generalists are coming in big time. We're seeing more and more interest from, let's say, like smaller institutional players. We've got one small pension fund from Switzerland that just came in. But many of the conversations that we have with institutional players is actually they are telling us we want to sell gold now because we want to take some profits now. Yeah, it's already 3% of our allocation. That's too much. Yeah, we're getting nervous in our investment committees. So I think this is still, to sum up, this is a bull market where the Western financial investor hasn't really participated yet.
Absolutely, and I think to your point earlier about how in this cycle so far the pullbacks have maybe been shorter and shallower than would be expected, has maybe given fewer opportunities for those investors to come in as they otherwise might have done. Before we move on, Frank, I know you touched on the paper market earlier, but do you have anything to add to that?
Well, I think that the days of paper gold are coming to an end. I think it's the price of gold is going to be set by those that take physical delivery, not by those that are trading with leverage, which has been the game in the past. That game is on its way out. So I think I have an opinion. If you own paper gold, you don't own gold, because if there's ever a crunch, a currency crisis, which I see coming, I don't know how it's going to come, but it's going to come from somewhere. At some point, we're going to have a currency crisis. I think because if fiat currencies are in their death throes, and we're going to be watching these convulsions for years to come. And if there is really a crunch, I don't believe your paper gold is safe from confiscation.
If I could add, I think it's interesting as well, because we're chatting with members this week. There's a lot of people in town, but talking about the interest generally, but from the pension fund community, wanting to get out of ETFs and holding something physical. Can you set up a SIP? Can you? And many firms are still at the beginning of that journey, which I think we find surprising, but wanting to educate people in terms of, one, if you're a fund doing that, it's very straightforward to do. You need to ask the questions and get on board. But I think my biggest note this year in terms of how things have changed is just the amount of hedge fund interest, pension fund interest, that we're not just, we got into a bit of a sticky position on an EFP. No, we want to be long-term players here. So it is this recognition of physical is king. You need to have access to it.
Very good.
If I can add one thing, after doing big keynotes, and especially in Germany, the sentiment in Germany is as negative as it gets. Yeah, it's really the center of pessimism. Yeah. But if you do a keynote
just
there,
generally as a people, or
yes,
just at the moment. Okay.
No. Viennese people are said to be like really grumpy and negative. Yeah, and I'm from Vienna, but Germany is like a different level of pessimism.
Okay.
Yeah. For a good reason, perhaps. But if I do a keynote there, afterwards there are people approaching me, and back in the days they would say, okay, where's the price of gold going? Which mining stock should I buy? What about silver? Now people are asking me, do you think there will be a gold confiscation? Do you think there will be like new taxes on gold? So all those questions are telling me that people are losing confidence, losing trust in governments, and they're expecting like more financial repression and various ways to make it harder to buy or sell gold actually. And I think we've seen it in Italy recently. I don't know if that's really gonna happen, like a special tax. Do you know what it is in detail, like a special tax?
Oh, the tax. I thought you meant about the conversation about getting the gold back from the ECB. Yeah. I commented it on Twitter. I said, because I'm Italian by heritage, and I said, good luck getting Italians, the most cynical voters on the planet, to turn in their gold to the government or declare their gold to the government. That'll never happen. Never.
So I think, Russell Napier said financial repression, that's stealing money from old people slowly. And people ask me about the end game, and I think it's like, financial repression in combination with structurally higher inflation rates. And it's probably they give you a harder time to buy and sell physical gold. Yeah. So in Germany now, I think 2,000 euros, that's the limit. If it's above, and you cannot buy an ounce of gold anymore without showing an ID. So I think those things and those special taxes, if you don't have all the records of your gold purchases, I think that's gonna happen going forward.
I agree.
Which maybe brings us then to the next round of questions, which moves on maybe from physical gold to the miners themselves, which is probably of much interest to the audience here. Of course, gold miners in particular have delivered very strong returns this year, and active funds, of course, such as the Baker Steel funds, have done substantial outperformance. So it'd be great to get your views on the investment strategies across the company tiers, from the risks and rewards of the juniors and the mid-tiers and the majors to the royalty companies, and maybe touching as well on the M&A landscape. So maybe if we start with you, Ronnie, maybe as a fund manager in this sector, it'd be great to hear your views on where you're currently focused within the gold mining investment landscape and how you're balancing that risk and value.
So we're actually in our fund, we're not long only, we're trying to understand the gold cycle, and based on that we're saying, okay, now we're on the risk curve, we're more in the silver junior space or more in the, let's say, royalty and major space. Yeah, our signal has moved for the first time since December 2023 from offensive to neutral. So we took some profits in some smaller names, let's say lower quality names that we owned and where we had like a tremendous performance. So we got a little bit more defensive. Usually we would have like the tax loss selling season now, but you have to be a real financial genius to make like tax losses on mining stocks this year. So I don't expect too much of that tax loss selling. I would expect liquidity to dry up over the next couple of weeks. All fund managers basically closing their books and calling it a day. So we put in some stink bits for some quality names that we like. And, I've met like 200 companies this year, and I can tell you I've never seen the mining industry in a better shape. I think most of the companies, the producers, they're still having pretty conservative base case scenarios, like 2,500, 2,700. Nobody has like 4,000 in their models. I'm seeing M&A activities that actually make sense. We haven't seen like crazy deals with huge premiums yet. And I think that, actually for what I would call the spreadsheet people outside of the mining industry, I think, the mining space will show up more and more on their filters, on their watch list, because actually there's a tremendous amount of value in the mining space now. There's just one thing, and I said that recently at a conference in Zurich. I think everybody in the gold mining industry is hoping for the generalists to come. I hope it's not like waiting for Godot, but I think it's really important for the industry to make a simple and sober case for mining, and not, overwhelm generalist investors with, drill results and geology, and so really make a very simple case, create a strong narrative, and then deliver. And then I think there will be lots of capital available in our space, but I think there's still some homework to do for the mining industry.
Yeah, absolutely. And coming to you, Frank, of course, you're renowned for your investments across all sizes of companies in this sector.
Yep.
It'd be great to share your thoughts as well as on some of the M&A in the sector as well.
Well, first of all, I'm not a portfolio manager, so I can't give portfolio advice. My MO in this industry has been for many decades now to build mining companies from scratch. So I find my best returns is to find an idea and work it for 3 to 7 years, build a major gold mining company, and it will obviously have a lot of value once you succeed. And we've done this about 4 times already in the last 25 years. So that's, if you have the patience, but you have to have the patience, because building a mining company is not easy. There are a lot of challenges, and there's lots of ups and downs. But if you trust management, as I work with management groups that I really know well and trust. They're very good at both the capital markets and the operations. And if you have the patience, the best way is to back a really great management team that has a plan to grow a large mining company and stick with it. That's. Now, as far as what's happening in the marketplace, I think, obviously for the senior mining companies, it's going to be very difficult to grow, very difficult to grow. And that's why they're all starting to look at critical minerals as a way to grow their business. But to grow in the gold side is almost impossible for the Newmonts and the Barricks. Where do you go? So the money to be made, in my opinion, is going to come from owning the juniors and the intermediates. There's going to be a lot of consolidation as this market heats up. A lot of consolidation. There's going to be a lot of disposing of non-core assets by major mining companies, and therefore the creation of new mining companies, which will then create even more consolidation. And for the bankers, if there are bankers in the room, it's going to be raining fees for the next 5 years or so, because I think this market's going to be with us for a long time. What I like to do best is looked up broken companies that have great assets but were mismanaged, and then taking them over either through bankruptcy or whatever, and putting in the right management, the right strategy, getting rid of all the debt, recapitalizing them, whatever, and we've had a bit of success doing that. It's like one man's trash is another man's treasure. And that's the way I see it. So there's still opportunities out there, but they're getting harder to find.
Absolutely, makes sense. And Ruth, would you have anything to add on the miners side, or?
I think from our side, in terms of engagement on the mining side, I think we definitely are the ones providing demand. I think over the years, we've had many miners say we don't have to worry about where the gold goes after the mine fence, because it just gets turned into cash. And I think that's the positive side, certainly on the gold and silver.
Yeah. Great. Well, before we move on to some audience questions, I had one more final question for you, I think, which everyone here would probably like to know, which is, what are your gold price predictions for 2026? Let's start with you, Frank.
I've been asked that about 10,000 times in the last 25 years. I've never given a price prediction. I think it's a fool's game. And I find it strange that these analysts come up, it's going to trade at $4,750. Where do they get these numbers from? Who the hell knows? I can tell you this, it's going higher, a lot higher, over the next number of years. And that's all I know. And it could go exponentially higher. I have no idea, but it's going higher.
Exponentially higher. Okay, Ronnie, where would you put it?
Well,
sorry, I set you up there.
No, that's okay.
Don't make a price prediction.
That's okay. We sat here like 1 year ago, and the price of gold was 2,700, and we were wildly bullish. Yeah? And I think silver was last year like 29. Yeah. So I think we've had a really good run, and I would say we're in a bull market. Yeah, we're in a big bull market where gold is still underowned in the Western world. And we put out, in 2020, we put out our long-term forecast, and we presented our monetary model, because I think gold has to be valued or modeled like a monetary asset and not like a commodity. So a very simplistic model based on M2 and M2 growth. And we said in an inflationary scenario, 8,900 by the end of this decade, so 2030. Now, when we put out that report in 2020, people said, those guys are crazy. Still, people think, this is like an outrageous price target, 8,900, but that's actually a CAGR of 16.4% from now until 2030. Yeah. Now, is it impossible? I don't think so. And back in the days, people would have said gold at 10,000, that's gonna be like Mad Max scenarios, riots on the street. I don't think so anymore. I think people get used to high prices, and I think this denominator decay, this will continue. This melting of the unit of account will continue, unfortunately. So I think 8,900 by the end of this decade is pretty realistic.
Okay. And Ruth, what is the LBMA?
Well, I was just commenting in thinking about how the world gets used to these high prices, because it's only 5 years ago that gold broke through that psychological ceiling that was the $2,000 gold price, and that was August 2020. If you cast your mind back, huge uncertainty in the world. There was no hope of vaccine on the horizon at any stage. Macroeconomically, we're in a very negative position, and you could actually see you broke through in August, and then a sizable 8 to 9% drop when the news about a vaccine came out. So I raise it because I think gold is a canary in the coal mine in terms of hopes and fears of the geopolitical and macroeconomic world out there. And I think you see this in a lot of the risks. There's a lot of uncertainty. So, I think a lot of our forecasters are certainly looking at $5,000 relatively near future. But I guess a question I would maybe throw back to the panel, if I could, because I think it's easy to get swept up in the bullish. Could there be a headwind that we're missing? Like, what could change that? And maybe you would say nothing is going to change that. We're going to 10,000 no matter what. But certainly, I think the world will be watching what happens with the Fed and Lisa Cook in January. But I was just curious for my other panelists, if there's other headwinds, could you envisage a scenario where that changes, and what would that be like?
World peace.
I agree. Without sounding like Miss America, it is world peace. But
yeah, I don't see it. I'm in the camp that there are so many factors lining up to make a positive case for gold. So many factors that the probability of some miraculous outcome is just zero. Like a miraculous outcome where it dictates a lower gold price. I just don't see. I think we're coming to a very critical moment in world history, and there's going to be a change, and that change could be very messy, very chaotic, and very dangerous. And we've seen it before throughout the century, so it's happening. I just don't see any probability that we're going to have a nice outcome where gold goes back down to 2,000 or 1,000. I just don't see it.
Okay, thank you very much.
Like a big macro event like 2008, 2009, where kind of a liquidity crunch, but gold was down to 660 in October 2008, but we know what the reaction function of central banks is, and we know that the next round of QE will be tremendously larger than the previous one. So I would say that should be only like a small correction.
That you're talking about major risk event, people going to the most liquid point. Certainly that's something the data really shows in terms of gold's behavior. You do see it come down because if you need to get out of other positions, you need to go where the liquidity is. Where can you get cash? And that's going to be the gold market.
Gold, yeah. Okay, well, thank you very much. Should we open up to questions now? I think there's a microphone there. Here we go.
Thank you. George McLeod. My question is about black market gold smuggling. there's reports that the total ounces produced globally are between 20 and 40% more than what is reported publicly. And there's a tremendous amount of smuggling, especially via West Africa. So I'm wondering, is this an interesting subject from an analytical perspective in analyzing the gold price, or is it more background noise? Thank you.
I think it's a rising concern. I think as higher prices attract all investors, including the nefarious ones. So people do need to be careful about who they're dealing with. I think it's a growing recognition. It's something we've campaigned for about 5 years to say major gold hubs have to take these issues seriously. The gold laundering is on the rise because it's an easy way to move money around the world, just from a simple money laundering side of things. So I think that's being led by major nations. We announced when we were in UAE last week that we're refreshing our own recommendations of trying to bring people together to end gold laundering in all these major hubs. And that needs industry, it needs trading hubs, but it also needs government and law enforcement.
Okay. I think we have time for one more question. Yep.
Yeah, so some of us have been in the market for a really long time, and there have been times when delivery has been an issue. And if gold is mined with copper a lot of the time, copper is going into deficit next year. You've got a lot of paper gold being traded or future gold being traded. You have lots of liquidity in the ETFs. And it used to be they wanted to audit. I think Frank wanted to audit some of the ETFs at some point in time. Or maybe it was Sprott. Is there going to be an issue with physical delivery and auditing who owns the physical gold? Is there going to be delivery issues because of the physicality of gold? Could that disrupt the market?
I mean, what I would say is gold is ultimately hard money, right? It's hard enough if you drop it on your foot, it's going to hurt. So there is a physical dimension to it that's different than currency, and you have to plan for that. So if you think about some of the challenges that happened earlier in this year with US tariffs, it's partly getting it across the ocean and onto US soil. It's also getting it into the right shape and size to be delivered into the paper markets or the CME. So I think it's something we certainly continue to call as the world becomes more complicated. There's a need for standards to be as streamlined as they possibly can. And it's one of the reasons we have been a big supporter of the Shanghai Gold Exchange from their very outset in wanting to ensure that there are global standards to make gold as fungible and as liquid as possible. And you're right, the physical side of that is important. But I also would say you need people who understand the practicalities of that. And certainly as we see a lot of banks coming back in who maybe, or joining for the first time, are really needing to upskill themselves and bring in talent that understands that physical side of the hard money.
Do you think there are enough people who understand that physical side? Because it is quite different from normal paper markets.
I think there's been a lot of movement. I think with some of these big new names coming in, I mean, Tether has obviously taken some key hires. So I think that there's resource out there. I think it's also something that we are looking to make more transparent in terms of the work behind the scenes that's done on a London market basis. But I think that would be good for all major centers, including China and the new ideas in Hong Kong in defining exactly what they're doing. So it makes better sense to people who have questions. Certainly one of the main things we tried to get rid of in the gold market is conspiracy theories. No, not all of them, because some of them are quite entertaining. But I think having transparent data goes a very long way, particularly on the holdings. And certainly that's something we're doing now, but looking to see, could we enhance that? Could we do it more frequently? Could you break down the free float, particularly on something like silver?
Okay. Thank you very much. Well, I think that's all we've got time for today. So thank you very much to the panelists, Ruth, Ronnie and Frank. Thank you very much for your time, and thank you everybody for listening.
Thank you very much.